in my top left-hand corner. Let's start with Emma.
Yeah, so I'm Emma. I'm the founder of Genesis Engine, and we're an AI research company based in Northern Ireland. We've developed a novel technology that creates and integrates with other technologies to kind of provide context, information, real-time communication and action. So we're currently focusing on like AI managed services and tools to grow small businesses online, like SEO, predictions, simulations, that kind of thing. I'm really just interested today because, you know, we are a research company and we're looking for fundraising and pretty much ways to scale and get new employees and things like that. So,
okay, great. Over to Chris.
Hi, I'm Chris Chodakowski. I'm a founder of Flying Cactus. It's a Web3 game studio. And I would like to listen and share some ideas about the fundraising, because like Web3 space is changing a lot. And there are some similarities with normal market, traditional market, but also some differences.
Okay, thanks. Jeremy?
Hi, thanks. Yeah, I'm Jeremy Kopp. I've spent 30 years or so leading startups and growth companies, which involved raising investment on a number of occasions. I now run my own consultancy providing interim executive leadership, which also seems to revolve around helping firms raise money and indeed sell themselves for an exit. So I get involved in all of that, as well as helping bring on board new customers and help with business development and anything they need.
Okay, thanks, Jeremy. Hattie?
Hi, I'm Hattie Fawcett. I'm the founder of Focus for Business, and I run a funding accelerator designed to get you equity investment in 90 days. We've run the program for 3 years, 100 founders have been through it, and we've raised 5 million for the businesses that have completed the program in the last 12 months.
Okay, a crucial part of the jigsaw. And we got in FinBlock, we have Matt +1. So go for it, Matt.
+1. Yeah, so it's Matthew Jackson and Neo Who. Yeah, we're from FinBlock, and we're building a virtual reality personal finance app. So it's very exciting. And at the moment, we're at the pre-seed stage, and we're looking for a round of funding. So we're just going through the first steps of that. So we're eager to learn more.
Okay, great. Luke?
Hi, I'm Luke. I'm CEO of Adia. We use AI and smart controls to help decarbonize the most difficult buildings in Europe and the UK. And we're currently raising our pre-seed, having just come through the Carbon 13 Venture Builder program in Cambridge.
Okay, thanks, Luke. Henry, 30 seconds on you and what you're interested in tonight.
Yeah, so my name's Henry. I'm the founder and CEO of Wallet. We are transforming receipts into valuable digital assets. Our goal is to basically get rid of paper receipts, and we are a fintech company. We are planning to go for funding, so we are raising a pre-seed round, and that's what I'd like to achieve tonight. Yeah.
Okay, thanks, Henry. And I think finally, Sean.
Hi there. Sorry, I'm not on camera. I was a bit delayed on my commute, so I'm still in the car. I'm with Cyberhead Advisors, a small cybersecurity advisory firm, but I'm also working with 1 or 2 startups on fundraising. Primarily, my introduction to Simon was for nucleus selling, which is leveraging large language models to tailor the conversation in a sales engagement process to make those conversations more meaningful.
Okay, that's great, Sean. So the only person who hasn't been, well, hopefully most of you know who I am. So I'm Simon Howson. I head up tech law. Been a tech lawyer I've been around as long as Jeremy. So yeah, I've been doing this sort of thing for about 30 years. And I advise about 120 SME tech companies on all the things commercial, contracts, data protection, IP. David is my counterpart in the corporate team, and a fantastic counterpart to have. Does everything to do with corporate, which is more the focus of today. Things like the fundraising, the share options, and everything to do with shareholder agreements and acquisitions, M&A. And yeah, David will be sort of taking the lead in most of this. We've just been joined by Kitty. So Kitty, if you want to say a few words about who you are and what you're interested in, then we'll kick off.
Yeah, hello everyone. Sorry for being late. I've just been invited by Henry, so we're both working on wallet to digitalize receipts. So sorry, I'm not sure about the agenda, but I will roll on with what's coming.
Bienvenue, if I can guess the accent correctly. Yeah. Okay. So the first thing we're going to talk about is the advent of different forms of fundraising. It's no longer as simple and straightforward as it once was. We now have people who are going back to shareholders struggling because the economy, everything is difficult at the moment. And so they're having to be inventive, because the last thing you want to present to a shareholder is a down round, i.e. saying you want to raise money, but the value of the company is lower than it was when you raised last time and they put money in. Not a good look. So there's all sorts of ways of trying to sort of make this more palatable. So I'm going to hand over to David, who deals with this on a daily basis, to talk about advanced subscription agreements and other methodologies and things that are out there in the market at the moment to try and make fundraise get away, as opposed to sort of stall.
Thanks, Simon. So, absolutely, the last kind of 12 to 18 months, there's been a real pressure on, tech valuations across the board, which is a problem, generally, but a particular problem if, your last fundraise was, when it was easier to command a better valuation. And now, you go out in the market and you're, really struggling to raise at the same or higher valuation, just because of where investor sentiment currently sits. So as Simon said, a down round, it's not a good story to be telling new investors, because it makes them nervous that you're going to do another down round after theirs. And it's a terrible story for existing investors who like to see, every round, go up in price so that they can, feel like they're sitting on a nice paper profit with their investment. There are some strategies we can use to, either disguise or delay the down round. It's effectively, kicking the can down the road in the, the hope that valuations will recover, in the coming months or years. One way that can work quite well is with an advanced subscription agreement. In America, they tend to call them SAFE agreements or HIS agreements, which is an agreement where your investor writes you a check now, but they don't get their shares immediately. The shares are issued, generally on your next big fundraising, generally at a discount to that fundraising price. So it's a way to get some money in without having to actually set what the value of the company is going to be. We've also seen, another strategy is to give your investors warrants. So persuade the investors to invest at a higher price than they would have otherwise been comfortable with, so you don't have a down round, and you sweeten the deal for the investor by giving them a chunk of warrants at a relatively attractive price, so that if the share price goes up as you expect it will, then the investors got the warrants, which is the right to buy a share at the warrant price. So they can buy a share that's worth, say, £10 a share, and if the warrant price is £5 a share, obviously for every share they buy, that's an immediate £5 profit. So that's a way for investors to get a bigger share of any increase in value without having to have capital at risk. And that can sweeten things enough that investors will agree to a valuation that they wouldn't otherwise. We're also seeing sometimes, convertible debt as a way of getting investment in without having to crystallize the down round. Convertible debt is just, it's a loan. So in theory, it's going to be repayable in cash. But in certain circumstances, it can be repaid by you issuing shares. Each convertible loan varies, but typically it's for the lender, your investor, to decide if it converts into shares or not.
That's very useful. Thanks, David. Has anybody got any particular questions or issues they want to raise about topics that David just covered, or fundraising more generally and how best to structure it? One of the things people often ask is how to balance debt and equity, And obviously the answer is different from what it was a few months ago when interest rates, or a year ago, whatever it was, when interest rates were riding around 0%, we're now riding around 7-8%, and probably more for commercial loans. So debt has become a less attractive way of raising money, but obviously it's still the imperative of trying not to dilute yourselves too early. So, has anybody got any sort of input or comments on fundraising generally, or the debt versus equity dilemma?
I was just going to ask David.
Jeremy.
Just going to ask David to comment on pricing those discounts or the warrants. Are there any typical rules of thumb as to how low you have to go, or is it a question of trying to find a level that that the investors are happy with?
It's a good question. I mean, I think with advanced subscription agreements and safes, that's quite an easy one because the market standard is a 20% discount. So investors are getting a 20% discount on the next round price as their incentive for investing early. Sometimes you see higher, sometimes you see lower, but you know that's quite an easy market benchmark. When it comes to the warrants you're offering, I don't think there is a hard and fast market practice. I think it's going to come down to, you know, the difference between the price that you need to achieve to avoid a down round and what the investor would have been willing to pay. You know, how dramatic, you know, is that gulf that you need to bridge?
Okay, I think Henry, did you have a question or point?
Yeah, I did. And I still do. Could you sort of explain what would be the differences between going for convertible notes and advanced subscription in terms of the amount that one could raise? I mean, does that have an impact in choosing one?
I don't. In general, no. You know, it comes down to, you know, I would generally say, you know, speak to investors, find someone willing to invest, and then, you know, it'd be lovely to say to them, it's got to be this route. But, you know, I think I would be flexible. You know, if you want to give me the money, I'll work with you to take it in whatever route you're happiest with. Where I think, you know, there can be hard and fast rule is, you know, some funds have rules that they can only invest equity or they can only invest debt. And if you're raising money from, you know, private UK-based investors who want to get EIS tax benefits, I don't know if people have come across EIS. It's a government scheme to encourage people to invest in, you know, relatively high risk startups and scale ups. There's a few hoops to jump through, but if you qualify, your investors get a nice big tax break when they make, in the tax year, they make their investment, and then any capital gains they make, you know, if they sell at a huge profit, are tax free. So it really makes, if you qualify for EIS, it makes it much easier to get private individual UK taxpayers to part with their money. And that's never going to be compatible with a convertible loan. It would have to be a carefully drafted advanced subscription agreement, comes with a few conditions. So if you know, your target market is, you know, individuals who pay UK tax, I would probably say go the advanced subscription agreement route. I don't think people are going to want to make convertible loans. Otherwise, you know, I would have conversations with people, you know, find that they're interested, and then, you know, be flexible as to the precise route. I mean, assuming they're willing to write a big check. If you've got one person who's only putting in a small sum and they have, you know, very particular requirements, you know, maybe you have to say, sorry, you know, this time I don't think it's a good match, but let's keep talking and try and do something in the future. But, you know, if someone's check is big enough, there's very little limits in, you know, what I think, you know, we should be doing to get the money in.
Okay, Hattie, you've got a point.
Yeah, I'm interested, David. I mean, with the startups that I've been working with, they've had pushback from angels in the UK, particularly around the ASA, because there's no term sheet. And most angels don't feel comfortable signing up to a deal where they don't know what the terms are, and they don't have much control over converting those down the line. And I wonder, do you have suggestions for how you get around that, or what's your take on it?
No, it's a very good point. I think, you know, the way we discuss that with clients, you know, is generally, hey, you're getting a 20% discount as an incentive for that uncertainty. And also, if the trigger for conversion, I mean, you can also look at the existing documents and say, well, this is probably going to be the starting point. It's unlikely that there are going to be less rights for investors. So you've got an idea of kind of what the fallback position is. And if the trigger for conversion is, you know, a several £1 million fundraising round, that's likely to be led by, you know, a VC as a lead investor. And
I think that's where Angel's worries come from, because VCs are going to negotiate quite hard to make sure that the terms favour them and not other investors. I think,
yeah,
and the concern is actually.
No, and I mean that's very true. I mean, I think you know, any well-drafted ASA is going to have provisions in that it converts into, you know, the most senior class of shares. So there shouldn't be a worry that, you know, the VC lead investor in the future round is going to get a better class of shares. Okay, you know, that VC is probably going to have a lot more in the way of control rights and information rights than, you know, the smaller investors coming in on an ASA. But to be honest, that's always going to be the case in, you know, any kind of equity round. And it's probably, you know, it's probably right that they, you know, a VC has those rights because they've written a bigger check. And also they've got, you know, they've got the internal capabilities to really be, you know, watching what the management team is doing, supervising them, and, you know, providing that critical friend. Whereas, you know, if you're kind of almost a hobby investor, you have a day job, you know, maybe you've got a few investments to do, you don't necessarily have the time to be poring over every decision that your kind of portfolio of investments is making.
Thank you.
Nikita, you got a point.
I think you're on mute.
Yeah, hi everyone. Yeah, sorry. I just have a bunch of questions. Can I ask? I joined a few minutes late, so I apologize. Can I ask my questions?
Of course.
Okay. So I just have like a general market question. And my curiosity is like, you know, we know that like down rounds are taking place and liquidity is tighter. Have you generally seen that the market, the VC market, has stabilized in terms of the capital availability and the transaction volume? That's the first general question. Second question is, I'm from the US. I don't know the UK market very well. And our business is SCIS registered. Does that mean that we are also EIS registered, or is there a separate registration process for that? Question 3. Yeah, I'll stop there. Sorry, I want.
No worries. So, I mean, in terms of the general market, you know, the conditions aren't as good as they were 2 years ago. That's just a fact. Are there VCs with money? Are they doing deals? Are they investing? Are Simon and I managing to earn a living, you know, doing these investment deals? Yes, absolutely. I think where I'm seeing changes is the biggest pressure point is pricing. You know, the VCs are still investing in, you know, businesses they like, you know, with an idea and a management team they like, but they're driving a harder bargain. You know, they're either willing to invest less money, or if they're putting in that much money, they want a bigger amount of equity for their money. So I don't think it, you know, certainly in my career, it's ever been that easy to raise money. It has got harder, but it's pricing that's the real change. In terms of SEIS and EIS, I'm not a tax specialist. It may be that if you've got SEIS, you know, pre-qualified advanced assurance, you need to put in an application for EIS advanced assurance separately. But if you qualify for SEIS, qualifying for EIS should be, you know, very simple. You know, I would imagine it's just, you know, a different version of the same form.
If I can chip in there, you definitely do have to get advanced assurance for both, for SEIS and EIS. And if you don't specify that you want both, they'll only do the first one. So when you apply, you definitely need to say you're going for SEIS and EIS advanced assurance.
Right, the good thing is SCIS, as you probably all know, is now I think 250,000, whereas it used to be 150,000. So despite various tax breaks falling away, that's one which has been enhanced. And just one thing I'd chip in there. I mean, David dealt with a transaction, very complicated one for one of my clients. It was an M&A transaction a couple of years back now, and cut a long story short, the VCs who'd given early stage investment, had negotiated very hard before we'd been involved with the client and had got what they call blocking rights. So when it came a couple of years later to the sale of the company, and the founders who owned about 40% of the shares and the other shareholders who owned about 87% of the shares wanted to sell at that price, the 13% minority VC shareholders blocked it and basically negotiated a position whereby they got a lot more for their shares than the other 87% did. Most people think if you've got 75% or more, you're home free and you can do what you like. But if you're negligent in negotiating the terms or too lax early on, it can come back to bite you at a later stage. So don't assume that investor terms are always the ones you should sign up to, because they could cause you all sorts of problems down the line, even if the money's attractive now. Anyway, I think unless there's anybody else who wants to say anything on the first point, we'll probably move now on to the second issue, and then that I'm going to hand over to Hattie, which is what should one expect in terms of deck and presentation when you're trying to pitch your idea, your business to investors? Because it's no longer as simple as it once was, because the world is, as we all know, a very uncertain place, and the economy is all over the place. So over to you, Hattie, for your input, please.
Yeah, I mean, the first thing I would say is it's not just the deck. You need a package of documents. The deck is your ability to the role the deck plays is to show your vision for growth, but that's not enough. You then need to show that you have a clear plan for delivering that growth. So that's your financial forecast, and the expectation is 3 or 5 years, P&L, balance sheet and cash flow, and a detailed funding sheet within there, so that investors have an idea of whether they're going to get diluted with further funding rounds. And the third thing you need is a valuation. And, to David's point, valuations are definitely shifting at the moment, maybe less so at seed and pre-seed, where the SEIS tax breaks kind of have reduced the impact of valuation. But nevertheless, valuations are shifting all over the place. So you need 3 things: pitch deck, forecast, and valuation. And your valuation in the current climate has to be prepared with 3 things in mind. You need to make sure that you can justify your valuation. So you've used a range of valuation tools to give you a valuation range. Then you need to benchmark that valuation against your sector and against your stage of business, so you're in the right ballpark. And the third thing we're encouraging the startups I work with to do now is then to ground that in the current economic climate. So to look at valuations in the last 6-8 months and show that you're in line with those, that you're not still going on valuations from 2 years ago, for example. So those would be my key starter for 10.
And going back to the deck, does the deck now have to sort of, apart from the valuation, does it have to look like one which is prepared with different various economic scenarios in mind, depending on how the economy and the world does develop?
Well, I think it depends, Simon, what deck you're talking about. There's no such thing as one deck. Anyone who thinks you've got one deck is deluded. You've got different decks for different purposes. You're going to need a 10-minute deck for presenting to, say, an angel network. And that's a deck you're going to present. So there's less words on the screen. It's more about how you present it. You're going to need probably a long form pitch deck, so the sort of thing that's more like a business plan in a presentation that you might use for an SEIS or EIS application. You might also use it to give to an investor who wants to go down the line of due diligence and find out more about your plans. And there's every shade of grey in between, like the 60-second elevator pitch, the 15-minute or the 20-minute pitch. So it really depends what the purpose of the pitch is. And that's where I always ask people to start. Is this a pitch you're presenting? Is it the first time you've presented the opportunity to this investor or this group of investors? If it's the second time, why are they inviting you back? What's their area of interest? Because that will help unpack where you need to provide more detail. And a pitch deck is just the jumping off point for a conversation. So you've got to be ready to go wherever the investor wants to take the conversation.
And just going back to the point that David addressed a few minutes back, are you seeing the market as extremely difficult at the moment, or is it easing slightly? How's it going with the various companies that you act for?
It's definitely a challenging market. It's not like it was 2 years ago, for sure. Our Are founders still getting investment? Yes, they definitely are. In fact, just today, one of our recent graduates emailed me to say they've raised 400, but there's another 700 that might still come into the deal. So deals are being done. It's harder for sure. So you've got to be better prepared. You've got to stand out as an investment that you know, is worthy of somebody's attention. But deals are being done.
That's positive. Has anybody got any questions about deck process valuations they want to put to probably to Hattie? No questions on that?
Yeah, I've got a question.
Okay, go, Henry.
Yeah, it's around valuation. So, I mean, I think depending on where sort of the business is launching and where the funds are being raised, you know, you could have investors from the States, or you could have investors in the UK. Does that impact what your valuation is? Because, you know, I mean, I was speaking to someone in France and they said, you know, this is your valuation. And I'm thinking, oh, this is not what I was told in the UK. So, I mean, what would your opinion be on that?
Valuations definitely shift across geographic territories because our attitudes to risk are different across geographic territories. UK tends to be fairly risk averse. America tends to be a bit less risk averse, and the valuations reflect that. What I would say around valuation is it used to be, or about the sort of your story of growth and how that impacts on the valuation. It used to be all about growth at any cost and the hockey stick curve that everybody was looking for. That has fundamentally shifted. And now what investors are looking for, that you get to profit quicker. Personally, I think this is a good thing because businesses should be able to sustain their own growth. So anything that we're doing to get to profit and have funds that we can put back into our business to grow organically is powerful anyway. But it's a definite shift, and that's across all the territories, and is so it's definitely one to think about wherever you're raising.
Sure, thank you.
Thanks. Luke's got a question.
Yeah, thank you. Just a quick one. So Adia is a hardware-enabled software business, and one thing that we've heard when raising a seed is that due to the need for more funds for expansion and longer route to market, that essentially you should be willing to be a little bit more flexible on dilution for a higher valuation to get more cash in the bank. And examples we've been told have been, you know, rather than sticking to the 15 to 20% rule of thumb for pre-seed, to, you know, be flexible to go up to 25 so that you can get more money in and go further. I'm just wondering, from your perspective, have you seen any rules of thumb between software and hardware businesses?
I hate rules of thumb because it's where it's where things go wrong. You know, rules of thumb are for businesses that look alike. Does your business look like any other business? You know, you've got to value your business, the progress you have made in your business, therefore the risk you have reduced. So rules of thumb for me are just a non-starter, unless you want to, you know, be very bland and generic. In terms of hardware, software, look, there are definite sectors that are more appealing to investors. You know, if it's tech, if it's SaaS, you're going to be more appealing to an investor. Is that right? No. All business models have the potential to offer good returns to investors. But what it is doing is it does mean valuations differ between sectors. It also means the popularity of your deal will differ between sector. You'll have maybe fewer investors. So that's why valuation might be shifting as well, because if there are fewer investors, then investors can, you know, demand and supply are out of kilter, and investors can demand a valuation in their favor. So you do have to be flexible on valuations, but I'm not going to give you a rule of thumb because, as I said at the start, you know, they're meaningless to me. Is your business like every other business that's out there? Then use a rule of thumb. If your business is doing something unique, if you've made decent progress, if you've got value in the business, you shouldn't be using rules of thumb.
Coming back to valuation, Hattie, is that something that you would cover, or is it something that you'd say go to an accountant to look at all the facts and figures?
Not. I mean, most accountants use very classic models for valuing businesses, and those models rely on stable and predictable revenues. I work with pre-seed and seed businesses. You show me a pre-seed or seed business that's got predictable revenue, if it's got revenue at all. So we don't use the accountant route. We use a three-stage process that allows the first step is to value your business using proper valuation techniques, but ones that are appropriate for pre-seed and seed. And we use a number of them so that you get a valuation range, high point, low point, midpoint, so that you know where the frame is. Then we're narrowing that down by benchmarking your valuation against your peer group based on sector and stage. And then we're using a third filter, which is what's happening in the last 6-12 months in terms of valuation shift. And that's where we pay a subscription to some specialist corporate finance databases, so we can give our startups access to that data. You can see what funding rounds have been done in your sector. You can compare yourself with businesses that are at a similar stage to you in your sector, and you can provide that evidence to investors to say, this is why my valuation is the right one. I've been through a three-step process, and here's the evidence.
Well, that's a very interesting, very comprehensive, very logical way of looking at things, and feel very helpful for all the companies that go through your program. Sean, you have a question or point?
Yeah, just a quick question to Hattie on the pre-seed or seed stage appropriate valuation multiples. In business school, they teach you about the DCF and all the others that don't apply. What is a appropriate one for a seed pre-revenue business?
We tend to use three. We use the Berkus. We do use VC, but VC is effectively using some of the DCF calculations underneath it, so it's not ideal, but it depends on your business model. It can work for you. And then the third one we would use is a scorecard. We do run a couple of DCFs on top of those, but usually if you've got no existing revenue, then it's probably meaningless. So we go back to the three seed stage valuation methods.
Thank you.
Okay, that's extremely helpful. Thanks, Hattie. Okay, let's move on to the third topic for discussion, and we'll go back to David on this. What to expect from the process of the transaction in fundraising? What do you need to do to get yourself ready, and what should you be looking out for during the process, things that you need to be aware of and to be mindful of so that you don't screw things up later down the line?
Thanks. I think the classic question that we get asked by clients is, how long is this going to take? And the answer is kind of, how long is a piece of string? The only reliable thing I can ever say about timetable is it will take at least twice as long as everyone planned at the start and expected. It's definitely not something to leave to the last minute with the best will in the world. There's a lot to get through. There's a lot of different parties to, kind of marshal, and, it's never going to be a completely smooth process. Your relationship building with investors can take, months or years. And from the point, particularly with a VC of saying yes in principle to actually getting cash out the door, you're measuring it in months, not weeks. If you're doing that in, 3 or 6 months, I would say you're doing relatively well. In terms of preparing, as well as, getting your presentations ready, keeping contacts warm, letting people know what you're up to from time to time, so that when you go to them with a firm, we want to raise some money, they're going to look at you, they're going to be better disposed to you than someone that they don't know, that they don't have a relationship with. We would also say, if you've got investors who are going to be doing due diligence, get your data room together so that, once you've signed the term sheet, you've signed the non-disclosure agreement, you can just, give them access to the data room and they can see all of the documentation they need to see immediately. You're not left scrabbling around evenings and weekends to put all of that information together. also have a think about, where are the skeletons in the closet? Where are the little issues with the business that you can tidy up beforehand? Partly it saves time, partly it gives your investors that warm, fuzzy feeling that they're investing in a really well-run business that, doesn't have any issues with it. It also takes away excuses, they can use potentially to, knock the valuation or give you less money than they were originally planning to. And the process will have different kind of work streams, some of which work, run concurrently, due diligence, negotiating the subscription documents, which is probably a shareholders agreement, some new articles, maybe a subscription agreement. If you're going to be giving some warranties, you'll have, a letter setting out all of the matters that aren't as warranted. And then you maybe have some other bits of paper employment agreements, if you're having to put in place a share option plan. And then the very mechanical documents that just make things happen or approve things, board minutes, shareholder resolutions, company's house forms.
Okay, does anybody have any particular points they want to raise on that? And while you're thinking about that, one of the things I wanted to mention was people sometimes ask us, where do we go for the money? And if you're not going through a program, comprehensive program like Hattie's, you might say, who do I apply to? Which VCs are relevant? One of the things that's suggested is go on to the crowdfunding platforms and sign up, and then you can get access to who's been investing in what. And if you've got a viable proposition, it's a good idea to tap into the same people, same VCs who've been investing in your sort of area previously. So that's one idea. Anybody got anything they want to ask or say about the process transaction? Jeremy?
Yeah, I was just going to make a point and agree with David that in my experience, the reality is you're constantly fundraising. So keep those relationships with all kinds of investors, both potential and existing, going. And that, the fundraising actually just manifests itself in getting rounds done at certain times, but you need to be constantly having those discussions and nurturing those relationships.
Absolutely.
I would also say between kind of formal rounds, don't forget your existing, shareholder base. The easiest people generally to get money from are your existing investors, and you never know when you're going to need an emergency round, and they're likely to be the most supportive. So, regardless of what obligations you're under to send, quarterly accounts, give people a periodic business update. It can be nice and upbeat. Look, these are all the, successes and wins we've had since I've last been in touch. These are all our plans. Make them feel valued, make them feel loved, and, make them feel positive about their investment. Some of our clients even have, like an annual dinner or an annual drinks event, again, just to build that relationship with your investors.
Emma, you've got a question or point?
Yeah, okay, everyone always talks about like the documentations, and I've got like a list of everything you're supposed to have ready when, it's time to take the next step, but no one ever talks about like what technology they actually want to see, like how much of the code base, how much of the IPs and stuff like that, like how much of that do I need to have ready? Because obviously it's been like 4 years of work and we don't have a lot of documentation for anything. So like, how far do I go back other than, like what we already have that works,
It's a good question. I think, and I'll be interested in Hattie's view, it's going to depend a little bit on the investor and your technology. And anything that's really key to the business, if you are, some kind of software as a service, and the code was developed maybe by, or partially by an outsourced developer, sitting in Bulgaria or Romania or somewhere, it's likely that the investors are going to want to see the assignment document where the copyrights in that code were assigned from the people who created it to your company as a minimum. Whether investors are actually going to get kind of commercial technical due diligence done on the code itself and how it works, I would say is less common. What do you think, Hattie?
I think it depends on how much you're raising and the stage you're at as well. If you're raising a ton of money and the and the technology is absolutely the key piece of value in your business, then yeah, people are going to do their due diligence, and VCs will do a lot of due diligence around the tech if they believe that is the value that they're effectively buying into. If you're quite early stage and the tech is important but not the only piece of value, then the due diligence may be less. And also, if the tech can be replicated, so okay, you're doing it this way at the minute, but it wouldn't be impossible to transfer it to another set of developers or whatever, then there'll be less concern. So it really depends. Early stage angels, unless that tech is absolutely fundamental to the value you're delivering in your business, I think a lot of angels will go with what you say. And do a demo of the platform, but probably not dig so far into the code. But if you're doing VC, you can expect some quite hefty due diligence. And if you're raising a lot of money, you can expect some hefty due diligence.
Yeah, so it is like, obviously it's very primary to the business. I mean, essentially, to dumb it down, it's like Jarvis from Iron Man without the theatrics and the suits. So there is a lot of, obviously stuff there. And then I guess it's what is that actual due diligence process? Like, is it engineers that look at the code base? Do they run tests? Like, because obviously it's not there's SaaS products that are attached, but it's not, you can't physically see the knowledge and the data unless you actually look at it and look at the models and everything else.
Again, it really depends who's investing. I was at Moonpig when they took on investment, and in the early days, it was about being able to show that you could document the code, being able to say you had control over the code. But the minute the numbers of investment was going up, they would get somebody who understood the code to come and look at it and to critique it and to give their sense of the code. So, it really depends. It's impossible to answer in generic terms, but you should definitely be prepared and at very least have some form of documentation around the code, have some protocols around accessing the code if you were ever to fall out, for example, with your third-party developers, if that's the situation you're in. If you're in-house, you should have, if your code is developed in-house, you should have some protocols around what you would do if a key person was no longer available to you. Heaven forbid somebody should fall under a bus, but people do fall under buses. So these are the sorts of questions an investor will ask if you are raising significant sums of money and code is instrumental to your business.
One question. Sorry, go on, Jeremy.
I'd say as a minimum, you should be able to demonstrate that you know what you've got, where it is and what it does, and how that contributes to the value. So make sure you understand where everything is and how it's all arranged and connected and whatever. And that's just, that just shows you're in control.
One of the things to make sure a lot of people ignore until it's sometimes too late, get a good shareholder agreement in place to make sure you know what happens if somebody wants to leave or somebody does fall under that proverbial bus. So you don't have a situation where the company's in limbo, and that could be very distracting or off-putting for investors. Henry, you got a point?
Yeah, thank you. So one of the questions I've been asked a few times is how copyable is your solution, or how nickable, if I can use a different word, is your technology. To me, as a technologist, I say to people that every technology can be copied. Just like Twitter was copied by Facebook. So, what's the importance of, having a tech that cannot be copied or cannot be copied for a long time? Does the investors actually care about that?
Yeah, so I'd say this feeds into your valuation. So yes, everything can be copied given enough time and money. But if you can quantify that and say, look, we reckon there's 10 man-years work in here and it would probably cost someone $6 million to recreate, then that gives you a baseline or another figure to figure into your valuation. So that's part of the drive behind the question is, if Fred down the road can reproduce it spending 50K, then that gives the VC an indication of what the value is of your business.
Got it.
There is the thing to add from a legal perspective. Obviously, if somebody actually copies your code, then you can sue them for copyright infringement, assuming you can prove it. If they just take the idea and do it in a different way, then you're outside of copyright. So that could be problematic. And in the UK, patents which go to protecting ideas often are inapplicable and not very useful in the context of software. So I wouldn't rely on them. But yeah, Jerry, I sort of second Jeremy's words on that. Any other points or questions?
Just answering Henry's point, and I think we would always advise flagging barriers to entry. If you've got first mover advantage, that's great, but you can't rest on your laurels. You need to innovate, or whether the plan is to reach a scale where it becomes very hard to compete with you. That Uber tries to have that in their markets. Actually coming up with a platform to match drivers with riders isn't that difficult. Lots of other people have done it, but Uber is so entrenched in their key markets. It's not always been true. They've been pushed out in some in Asia, but where they are popular, they're difficult to compete with because they're going for that kind of monopoly effect. All the riders are with them.
We touched on this idea, and Hattie's got obviously a sophisticated process for doing this. How, when you've gone through all the stages and the filters you mentioned, Hattie, how do you actually match in your 90-day program? How do you match the companies with the right sort of potential investors? What's the process for that?
Very simple. We have a target investor profile. So I'm not a fan of just spamming investors. You want to speak to the right investors. So we develop a target investor profile, which is a series of questions we take our founders through to enable you as the founder to understand where you should be putting your efforts, which type of investor and which groups of investors you should be going after. We then use that target investor profile to give you a list of names of investors who back businesses like yours. We call it our investor hit list, but there's no guns involved, I can assure you. And then we give you a process. We give you a process for finding those investors, reaching out to them, standing out to them and building a relationship with them, and ultimately pitching and moving into a due diligence process with them.
Okay, thanks. Has anybody got any further questions or points on this topic? Or otherwise, we'll move to the next one. Right. So let's go to the next one, which is something we can all share our knowledge and experiences of. What mistakes to avoid whilst fundraising? Has anybody been through a totally abortive fundraise and they think back and think, I got all of these things wrong, and they want to share that? or do we kick off again with the usual suspect, Hattie, who's taken people through this and will know what not to do? Okay, Chris is going to open. Chris is going to open up on some past disaster, I hope.
Yeah,
Go on,
yeah.
Chris.
I haven't done it, but I see many times looking at all the pitch deck presentations. For me, it's obvious to not do it, but people do it all the time. So I believe it's worthy. Like they often don't think about worst case scenario, what happens. So the simple question from investor VCs, what's going to happen if you don't sell that much as you predict? And people often get stuck, like they have no good answer for that. So thinking about the worst case scenario, because for investors is very important, and very surprisingly, people don't think about that. Therefore, I raise this issue.
Okay, thanks for that, Chris. Hattie, do you want to come in there again?
Yes. I think the mistakes to avoid, don't leave it too late. That's the big one, because it does take time, as David was saying. I mean, we say the funding accelerator is 90 days, so that's 3 months, but it can easily be double that in the current climate. So don't leave it until you've run out of cash to start thinking about cash. I would also say, don't assume equity investment is the only route open to you. There are other ways to fund businesses, and there's quite a bit of money coming out, particularly in the regions at the moment, from British Business Bank, for example. So, explore all your options. Explore grant, explore early stage debt that's specific for startups, explore equity for sure, and don't forget alternative finance. How can you make your cash go further with invoice factoring if you're already at revenue, for example? So explore all your options rather than just immediately assume it's equity. And I think the other thing I would say is surround yourself with people who can support you for the journey. It's really lonely being a founder, and it's really hard raising investment at the moment. So surround yourself with other founders going on a similar journey. Share your experiences, have a little bit of it's almost the group therapy, just to keep your motivation and to allow you to recognize that it's not you that's doing anything wrong. It's just the tough market. So it keeps you focused. Maybe get the right advisory team around you. Yes, you're going to need lawyers. Yes, you're going to need accountants. Yes, you might want people like me. That's your choice. But I'm thinking also be really clear about what's missing in your investment opportunity. Where are your weaknesses? What don't you have on the team yet that you would get if you had raised the money? Often there's some kind of gaps in go-to-market strategy or key elements of the commercial team. Maybe what's missing. Go find yourself those advisors and plug them into your advisory team or your non-exec team or your board, whatever you're going to do, so that you've got the support around you to make this doable. Don't do it on your own.
Yeah, they're all very good points. One of the things we see is when people ask the question, what are you going, from an investor perspective, what are you going to invest in? Is it the product that's paramount, or is it the team? And 99 times out of 100, they will say the team, especially in an early stage, because a good team can pivot and adapt to different market
people
conditions.
That make things happen, isn't it? That's the bottom line.
Yeah, it's exactly. Whereas a good idea, but not the right people to make it happen, it's an idea. It's not going anywhere probably. So people will not invest in that. David, in terms of fundraising exercises which you've seen go abort, apart from the points you've already made about getting documentation in order, have you seen anything else which kind of caught your eyes about things not to do, the things that you couldn't have sorted out from a legal perspective, but they've just gone wrong?
I mean, the good news is we don't see a lot of fundraisings abort. It's difficult to get to the sort of term sheet stage, but once you're at that stage, it should come down to kind of negotiation. I think where people look back at a fundraising and have regrets is where they've given away too much equity too early, too cheap, or where they feel they've given up too much control. You're going to have to give up some control to get money in. That's unavoidable. You just need to make sure that it's a conscious and it's a considered decision, that you're not inadvertently and giving up, the right to sell when you think it's the right time to sell. You need to understand and be thinking about not just focusing on that lovely big check coming in now, but thinking about, hey, in 3 years' time, when I've decided, I've gone as far as I can with this business and I want to exit and I've got an offer at a price that I like, who's going to stop me? Who am I going to have to persuade this is a good idea? Who can potentially, hold me hostage? As Simon said, we had that example a couple of years ago where it was a couple of VCs playing hardball and insisted on being paid more per share than everyone else. I was talking to a client at lunchtime today, at term sheet stage, where again, the VC was saying, well, we want a right to block an exit forever and ever. And I said, hey, I don't think that's a good idea. If we can get them, 2 or 3 times their investment back, I think, as a 5% shareholder, they just need to go with the flow.
Yeah, absolutely. Henry, and then Jeremy.
Yes, I've got a question around KYC. So, I mean, for small companies or startups, how do you, sort of perform know your client activities before bringing on an investor, so you don't have anyone with dodgy past history on your cap table?
I mean, I think it depends a little bit on your industry. I mean, the good news is for most of you, you're not going to be subject to the same kind of frightening obligations that lawyers, accountants and banks are. So, it's a good idea to do some basic, KYC, know who's investing, if there's any red flags, because of, where people are based or how they deal with you, maybe ask some additional questions, but you're not really worrying about it from a legal or regulatory point of view. It's more of a reputational risk. If you hear from a Mr. Escobar and every hair on the back of your neck is standing up, then maybe you need to think about, is this the kind of person I want on my cap table? The good news is, in terms of money laundering, startups are not a good route for money laundering. It's not especially high risk, because the risk of them just dying, unfortunately, rather than producing a nice clean source of funding, is just too high for most money launderers to be getting involved. But you're right, it's something to be aware of.
So basically you're saying as long as you make sure you go bust eventually, no problems subsequently. Yeah. Anyway, Jeremy, you had a point.
Yeah, I was just going to make a point about fundraising. Just remember that it's a sales process. So you need to be selling the benefits of investment in your company. So what quite often happens, especially with early stage and especially tech companies, is they focus on the features of that which they've designed. And everyone's very proud of it. It's the best thing in the world. And they spend all their time talking about what the stuff does rather than the benefits it provides to the market. And more importantly, the benefits going to provide to the prospective investors. So again, as Hattie quite rightly said, this is a people process, both people running the business, but also people investing. So ultimately, you need to convince them that you're going to make them a hero. They're going to generate return for their investment, either for their investor partners or for themselves. So bear that in mind. Don't get too embroiled in the what it is you do and the how you do it. Be able to express that in terms of the benefits for the investors.
Okay, unless anybody's got any further points on that, we're going to spend the next 5 to 10 minutes max, so you'll all be finished a bit early, on share options. And I'm going to hand that over to David, talk a bit about whether share options are still an effective way to entice people to join you, and what the best form of scheme would be for most people. David.
So for me, I mean, we do have discussions about, particularly Gen Z and millennials. Full disclosure, I just about qualify as a geriatric millennial. Whether we care about jam tomorrow or whether it has to be jam today. Basically share options are jam tomorrow. I think the answer is, if a share option scheme is properly explained, people value them. And in some industries, particularly tech, it's almost an expectation, particularly, with hires who've been around the block a bit, and if they're joining, a startup where maybe salaries aren't as high as they might be, or there's, a bit more risk than joining a more established business, they're going to want some share options. What I would say is, don't just present employees with the long, boring, dry legal documents that we have lovingly prepared for you. It needs a little bit of a sales job to go with it, a presentation, or a table with some numbers saying, look, our vision is to sell this business within 3 to 5 years. We're giving you these options. If we can sell at £50 million, this is how much you're going to be getting. If we can push that up to £60 million, look how much more it's going to be, so that people can smell the money and really, see the value and get excited about, pulling in the same direction as you to generate value, get to exit, and then make a nice profit out of it. In terms of, what to think about when you're designing a scheme, there's the basics. Who am I going to give options to? How many options am I going to give them? This is, typically you see in tech businesses, maybe 10 or 15% of the fully diluted cap table is employee options. Most investors are going to be very comfortable with that. A lot of investors are going to want to see that because they want to know that key people are incentivized. And then you need to decide, what conditions are going to come with these options. Is it going to be the classic kind of tech vesting schedule of third after a year, next third after 2 years, final third after 3 years, but then people can become shareholders, have voting rights, have dividend rights, and if you leave, and if they leave and you don't want them to keep their shares, you have to kind of pull those shares back from them, which is doable, but is always going to involve a little bit of paperwork? Or do you want to have what's called an exit only scheme, where you say to people, look, you've got these options, but they're not going to be worth anything until we actually exit. So you're never going to have dividend rights, you're never going to have voting rights, but you will get a share in that big payday when we exit in 3 to 5 years.
Okay, and is EMI the only game in town, really?
It's not the only game in town, in that there are other tax efficient or tax advantage ways to give employees options. But if you go to a tax advisor and you qualify for EMI, 99% of the time they will say EMI is the best route for you. And given our market, tends to be tech businesses that qualify for EMI options. I mean, I do an EMI option scheme maybe not every week, certainly every 2 weeks. And, I can't remember the last time I did a EMI, but still tax advantage schemes. In terms of the work we do, it's basically EMI, or it's, no tax benefits whatsoever. We very rarely do, CSOPs, save as you earn, any of the other kind of, tax efficient schemes that there are. And that's partly because they tend to be aimed at bigger businesses than we generally act for, but it's mostly because if you qualify for EMI, it's likely to be a no-brainer. That's the route to go.
Okay. Anybody got any questions or points about options?
Yeah, I just raised the thing to consider is how your option scheme spans geographic borders. They're often treated quite differently in different jurisdictions. Just be aware of that, especially if you've got people around the world. It may not be as attractive to them as you think it is.
Yeah, David,
it's a very good point. And the bad news is, if there are employees around the world, the tax treatment's going to be different in every jurisdiction.
Yeah, so we always have an accountant working alongside us when we're doing share option schemes for the tax issues and the valuation issues, etc. So intrinsic partnership for EMI. Anybody else got any questions or points about options? Okay, fine. We'll call it to a close then. I'd like to thank you all for attending. I'd like to thank David and Hattie in particular for their fantastic insights, as well as Jeremy gave us a lot as well. And I hope you all found it useful. Are you all comfortable with me sharing your email addresses in the sort of follow-up email? Yeah. Okay, good. All right, good to see you all. I'd like to say go out for a nice sunny walk, as I have done through the summer, but looking outside, that's not going to be the case. So better find something useful to watch on Netflix. Good to see you all.
Thanks, Simon.
Thanks, everyone.
Thanks, everyone.
Bye.
Bye.
Bye.